We're talking about the investment opportunities and challenges present in the infrastructure sector. What can the government do to bring the sector back on track? Joining me is Rajiv Lal, MD and CEO of IDFC. Rajiv, let me begin by asking you, the 12th plan has doubled the projected investment in the infrastructure sector from the 11th plan. Who will make this investment?
The plan document basically projects that 50% of that $1 trillion investment is going to come from the private sector. Over the last 5 years, we have actually been very pleasantly surprised by the appetite of the private sector to invest significant amounts in the infrastructure space. What the learning from this experience is that actually financing is not really a fundamental problem. If we have a portfolio or a pipeline of attractive projects with relatively predictable returns, the capital is there. The issue is actually creating such a viable pipeline of projects.
That still means that there's a large requirement of equity with 30% equity and 70% debt. Where will this equity capital come from?
You know, you're talking about, as I said, $100 billion a year in financing, of which $30 billion a year would be equity, $70 billion would be debt. In the scheme of things, for an economy that is as large as ours, that is not a very large amount.
What about deepening of the debt markets?
Domestic institutional investors in rupee bond markets have also been growing. I think slowly and steadily we are able to place more paper with the mutual fund industry. We have begun to access a small number of pension funds, and slowly but surely we are also being able to place paper with insurance companies. It will take time, another few years, before our insurance companies develop the track record and the balance sheet size to invest more in infrastructure.
What kind of returns can investors expect?
Between 15 and 20, 22 odd percent, in that range. Theoretically at least, there should be a number of interesting projects that could be done in India.
But the 15 to 20% return number that you've mentioned, that's not what investors have received so far. So why will that change?
Investors in public equity markets have not received that return by investing in infrastructure, except for very short periods of time where you may have ridden up with the market. Promoters, on their own contribution, they were able to attract a lot more capital. So, you know, if a project cost $100 or 100 rupees, the actual equity cash contribution from promoters wasn't very significant. The bulk of it actually came from third-party investors and debt providers.
Rajiv, the companies that you're lending to in the infrastructure space, do you find that these companies are having a hard time raising equity?
No, today they're having a very hard time raising equity, and that's because the whole policy environment in the infrastructure space is so uncertain.
And you're seeing that applying to the promoters as well, who were earlier plowing their equity back into infrastructure projects?
They'll be much more reluctant to plow additional money into infrastructure because they've been very disappointed with the results so far.
Rajiv, PSU banks have been seeing a lot of stress from the power sector. Why are you not seeing that kind of stress?
Because we had actually been careful not to underwrite very much or too much thermal power generating capacity. So, you know, a very large chunk of greenfield thermal generating capacity. What we've done in energy is that we have done a lot of alternative energy, first renewable energy first of all. So that has been one way for us to mitigate our risk. Secondly, we have funded operating assets. That has mitigated some of our risk. Third, we have funded projects that relied on either captive sources for the sale of electricity or captive sources for fuel. So that has protected our balance sheet.
Now, we've talked about power, but within the other spaces of infrastructure such as roads, ports, etc., where do you see the highest risks?
No, I think that the problems in roads are probably exaggerated. a lot of the problems in the road sector were really to do with procurement of land, which in turn was a lot to do with environmental regulations. So we are seeing some progress on streamlining of environmental regulations with respect to widening of existing roads. So once that happens, I suspect that some interest could return to the road sector. As far as ports are concerned, I think at least our exposure seems to be doing quite well, and we continue to look at opportunistically new ports to finance.
What would you recommend to investors on where to invest in the infrastructure space and what kind of returns they should expect?
Right. So the biggest opportunity in the Indian infrastructure space, notwithstanding all the problems that we've been discussing at some length, is really in funding or refinancing infrastructure assets that have already been built. Right. A lot of infrastructure assets are in long-term concessions. These concessions last anywhere from 15 to 25 to even 30 years. What we need now is to recirculate capital. So the initial risk capital that came to develop these assets can be freed up by another class of capital that will stay invested for the longer term based on predictable cash flows of operating assets.
So Rajiv, are you more confident about the infrastructure sector over the next 3 years than you've been in the last 3 years?
You're catching me at the cusp. I cannot say that with any confidence that I'm more confident for the next 3 years than I was if you had asked me the question 3 years ago.
Well, on that note, thank you very much for your time, Rajiv.
Thank you.
I'm now joined by Vibhav Kapoor of IL&FS. Vibhav, would you invest in the infrastructure sector from an equity market point of view? Are the low valuations of the sector what you like, despite the poor profitability?
See, on valuations, to address that question first, if you look at most of the companies and you look at their current profits and immediate projections, they don't look all that great. Some of them do, but a lot of them don't. But that is largely a function of the fact that profitability has been very severely impacted by all these factors in the last few months. Going forward, if interest rates come down and some of these measures actually take off from the ground, then the profitability of this sector should improve significantly going forward, and which means that since their prices have come down so much, the stock prices, if you look on a longer term basis and you factor in some of these assumptions, they would definitely begin to look cheap.
What kind of returns are you betting on for this sector? Especially for the long-term investors, what is the sustainable return you think?
I would think if most of these assumptions which we are talking about actually do happen, you could get a sustainable, growth of something about 15 to 17 or 15 to 18% of the next few years.
But 15 to 17% growth is only in line with nominal GDP growth. Is that sufficient return, you think, for the risk one has to take for investing in the sector?
Yeah, well, the nominal GDP growth I would take at least for the next, say, 18 months, 12 or 18 months to be somewhere in the region of 12 to 13% with, say, a 6% inflation and a 7%, 6.5 to 7% real GDP growth. So I'd say, if you get 17, 18%, that's well above the nominal GDP growth rate. And as I'm saying, probably in the first few months after these reforms happen, you could really get a significant uptick more than the 15 or 18% we're talking about. But over a sustained period of time, I think 16 to 18% would be the type of returns I would be looking for.
What in infrastructure looks attractive to you?
You've got one or two companies which are right up there, like L&T. Then you have a few medium companies in the 1 billion turnover range, and then you have thousands or hundreds of companies which are really small. So I think over a period of time you'll really want to see that some of these medium companies which are in the middle level right now are able to scale their activity significantly.
Well, that's optimistic.
Thank you, Punita.
Thank you very much for your views, Vibhav. Now let's talk to Tanveer Gill about what the rest of the market thinks about the infrastructure sector. Tanveer, what is the data showing to you?
Well, you have the industrials, you have the pure road project players, and then you have the conglomerates, Punita. So, the market broadly divides it into three segments. In terms of just the brokerage calls first, L&T, Cummins, stocks like IRB Infra, Adani Enterprises, Jayaprakash Associates, Reliance Infra, most of these stocks have more buy calls or hold calls than sell calls coming in there, with the exception of perhaps BHEL, where there's more of a bearish view. The best way to look at these stocks, as I speak to analysts, is on an EV per EBITDA basis, because that captures the debt value also for some of the projects, and also captures the execution risk that there may be for some of the projects that these companies hold. So, if you just take a look at the graph that come up on your screen, you will see that companies where the project execution has already happened and cash flow generation has already started, their EV per EBITDA valuations will be higher, for example in L&T or Cummins for that matter. From a 2012 return perspective, we've seen that L&T has done well, Cummins has done well, Jayaprakash Associates, Reliance Infra has done well. So the market also seems to be rewarding companies where already there has been a robust order book and execution of projects has happened on time. Punita, with that, well, given all the talk about infrastructure, what is in it for the equity investor, Punita? What's the opportunity?
Let's break it down by various segments. As you said, in the engineering space, companies like Larsen & Toubro, etc., their market caps are close to what you see, in the rest of Asia. And those companies will do as well as, they can generate their earnings. Now you look at in construction, there we have a whole lot of mid-cap companies with very low market caps. But that segment will also improve provided the investment activity picks up. And if you look at earnings growth estimates, some of these companies are actually showing possibility of 20 to 30% earnings growth. Now the question is that sufficient to offset the risks that are existing in the sector? But if that happens, then there could be upside. I think interestingly enough, road sector is one where India is lagging considerably versus the rest of Asia, and the market cap of the Indian companies is very low as compared to what we've seen in other countries. So for instance, in China, there's a lot of road companies that are listed, and their market caps are in the $2 to $5 billion range. So there's a lot of room for Indian companies in the road sector to re-rate to their Asian peers, provided, obviously we see that, there is investment happening and the road targets are being met. Well, that's my view. With that, we come to the end of this episode of Hot Sectors with me, Punita Kumar Sinha. Thank you so much for watching and have a great day.